Most people don't lose slowly. They lose because the odds are against them from the start. Let me ask you something. If a parachute failed 7 times out of 10, would you jump? Because that's the reality most people face when they try day trading. And yet millions of people jump anyway, every single year. And the problem isn't that people don't try hard enough. It's that they're playing the wrong game. Today, we're talking about the reality of day trading, why most people lose, and why trading more often usually makes things worse, not better. For most people, it's not bad luck. It's reacting to short-term price moves that don't actually matter and paying costs they don't even notice. This isn't get rich quick. This is how the market actually works. And this isn't theory. We've seen this play out before, especially in moments like 2008, when prices were moving violently and traders were forced to react. Warren Buffett's 2008 lesson, the legendary investor's insight. In 2008, the global economy was in the middle of a financial crisis, and fear was spreading across markets. In 2008, stock prices fell hard. And they didn't stop. Down one day, down the next, then down again. Screens were red. Prices were moving fast. This is the exact kind of environment day traders are forced to operate in. Millions of people were staring at their accounts thinking, if I don't sell now, I might lose everything. Warren Buffett, one of the world's top investors and the largest individual shareholder of Berkshire Hathaway, shared very wise investment advice in his 2008 shareholder letter, explaining that Berkshire Hathaway, a publicly traded holding company, lost market value because investors were panicking and selling the stock, not because its businesses were sold or damaged. Since the businesses Berkshire owns were still operating, the decline didn't concern him. Here's why that matters. Even as prices were falling, many businesses were still operating. People still bought food, still filled prescriptions, still paid for basic services. The businesses hadn't suddenly stopped working. What changed was the stock price, which fell because more people wanted to sell than buy. And stock prices can rise again over time. But that's never guaranteed, and it often takes patience most people don't have. Day trading requires acting on short-term price movement, not on whether the business itself has changed. So when prices dropped, many traders acted. They sold to escape the pain. And by selling, temporary price swings turned into real losses. Buffett ignored short-term price movement. Day trading depends on responding to it. And that difference doesn't show up overnight. It only becomes obvious over time, once compounding is allowed to work. Compounding means your money makes money, and then that money makes even more money over time. Subscribe for more videos like this. The compounding reality check. Let's kill a popular myth right now. The stock market doesn't make the average investor rich quickly. It makes them impatient first. Over long periods, broad stock markets have returned roughly 7 to 10% a year. That sounds great, until you live through how slow it feels. Early on, $10,000 barely moves. Nothing dramatic happens. Imagine someone who invests for the first time at age 25. A year later, they check their account. It's up a few $100s. Nothing life-changing. So they pull it out. And that's the exact moment they trade away the most valuable thing they had. Time. That's because, at first, you're just adding money to money. The real growth only shows up much later, when gains start stacking on top of gains. And that waiting period is where many people mess it up. We have real US data showing this. Studies tracking tens of thousands of American households found that the investors who traded the most earned far less than the market over the same years. Same market, same time period. Huge difference. That gap didn't come from bad stocks. It came from behavior, buying after prices rose, selling after prices fell, and interrupting compounding along the way. So, while the market kept working, many people kept starting over. And this is the moment most people don't even realize matters. Here's how it usually plays out. Someone invests for a year, sees nothing exciting, pulls the money out, then spends the next year trying to make it back by day trading. That's where people stop waiting and start day trading. And this is where most people think the market is the problem, but it isn't. Why day trading feels impossible for beginners. Jumping into day trading is like this. You've never played football before, and suddenly you're dropped into a game with professional athletes. They have faster systems, better data, teams of analysts, algorithms firing in milliseconds and often microseconds. You have a phone, emotions, and hope. That's not a fair game. and yet it's sold as easy money. And here's the part most beginners never see. You're not just trading people, you're trading machines. High-frequency trading firms use supercomputers to place and cancel orders in microseconds, capturing tiny price differences at massive scale. By the time a price updates on your phone, those systems have often already reacted. Their servers can sit right next to the exchanges. That's not illegal, it's how the market is structured. So you're competing in a game where speed is an advantage you can't buy. And it's why most day traders don't lose, because they're stupid. They lose because they're outmatched. And once you see the numbers, it becomes hard to unsee them. Now here's the uncomfortable part, because the data doesn't care how confident someone feels. The data, why most day traders lose. And the numbers are worse than people think, especially once you include costs. So here's the part most people never hear. When researchers actually tracked day traders, not for weeks, not for months, but for years, almost all of them lost money. One famous study of Brazilian futures traders found, after costs, almost none beat the market. The longer they traded, the worse results became. Another consistent finding found, frequent trading reduces returns.
Why?
Because every trade has costs most people never notice. First, there's slippage. That's when the market moves before your order fills, so you often get a worse price than you expected. Then there are taxes. Short-term trading is taxed more aggressively, which shrinks wins and locks in losses. And finally, emotional mistakes. Panic selling, chasing moves, and overtrading at the worst possible moments. Each one feels minor on its own. Together, they quietly stack the odds against you. When the odds are stacked against you, day trading stops being a strategy and starts to resemble gambling. Why day trading resembles gambling for most people? For many people, day trading starts to resemble gambling. Not because the market is random, but because short-term wins and losses push people to take bigger risks. And this is where things quietly go wrong. It often follows the same pattern. A win creates confidence, and confidence feels like skill, even when it isn't. Confidence leads to larger risks. Larger risks trigger emotional decisions. Emotional decisions increase the chance of large losses. But here's what almost nobody expects. The result isn't skill building. It's this: high stress, high risk, low odds of consistent success for most participants. You're not just risking capital. You're risking time, focus, and mental energy, all while competing in a zero-sum environment, where for every short-term winner, someone else is taking the loss. And that's why Warren Buffett has long argued that most people are better off with a simpler approach. By periodically investing in index funds, the know-nothing investor can outperform most investment professionals. Why index funds work? An S&P 500 index fund is not a stock. It's a slice of the American economy. And this changes how risk works entirely. You're owning 500 of the largest U.S. companies across technology, healthcare, finance, energy, consumer goods, and more. That diversification matters because no single company decides your outcome. This is the part most beginners underestimate. If one company fails, it barely moves the needle. If one industry struggles, others can still grow. Your risk is spread instead of concentrated. You're not betting on one CEO, one product, or one industry to be right. You're betting on the overall growth of the U.S. economy, which has the highest GDP in the world. That's why broad index funds carry less risk than individual stocks, avoid single company blowups, and don't require you to guess winners. They remove the need to be right about one thing and replace it with patience across many things. This is slow, this is boring, and this is why it works. Because the real advantage in markets isn't speed, it's staying invested when most people can't. The stock market isn't a casino, but for the average trader, day trading turns it into one. For most investors, wealth isn't built by predicting what happens next. It's built by staying invested while fear, noise, and headlines try to pull you out. Trade less. Hold longer. Let time, not emotion, do the work. This isn't exciting advice. It's just the advice that survives reality. And that's why Warren Buffett put it this way: the stock market is a device for transferring money from the impatient to the patient. Because for most people, the ones who win aren't the fastest, they're the ones who stayed. Thank you for watching and subscribe for more videos like this.